All right. Thank you, everybody, for jumping on today. We really appreciate seeing everybody again this morning, and thank our guests for coming on to share their information with us. I'm going to start off by having Eric walk through and introduce the TribeVest side of this deal webinar to everybody. It's kind of a new process we're going through this year, but Eric, you can walk people through. That'd be great.
All right. Thanks, Chad. Yeah. So my name is Eric Ward. I'm an LFI member, but I'm also working with TribeVest on the open tribe concept. So for this investment for the Motel to conversion, we are going to open a single investment open tribe. So what does that mean? It's a fully turnkey tribe. So that means TribeVest, we're going to handle everything. We're going to manage the entire process. So effectively, instead of investing directly, you can invest through the tribe. And the tribe will pool the capital, and then we'll make the investment. And this comes with, it's nothing different in TribeVest from a user perspective. You'll still see everything you're used to with equity and bank account and transactions, the full transparency. You'll see all of it. If you're new or unfamiliar with TribeVest, I'm going to post my contact information. Please reach out to me. I'm happy to talk about it or walk you through how TribeVest works or the interface. You can email me, text me, call me, and all of that's fine. So I just dropped my information in. So with this investment for the motel to apartment conversion, the tribe minimum is going to be $10,000. So instead of the minimum, I think is 100 going direct, you can come through the tribe for $10,000. We'll need a total of $100,000 in commitments to formalize the tribe and make it happen. So 10 people at 10K, we're golden. You can obviously do more than 10K. That's up to you. But the 10 is the minimum. So any amount above 10. We'll need your commitments by January 20th. That gives us time to get everything together for the tribe and bank accounts and all that stuff. I just posted the form in the chat, and I think it'll come out with the email too. The recording will also have it. Yeah. So by the 20th of January, if you'll post that form. So that's what's next. So what's next is listen to the presentation. If you're interested in investing through the tribe, then fill out that form and I'll be in contact with you. I think that's it, Chad. I do have to drop off early. I got to catch a flight, but I'll stay as long as I can. But so if there are questions, just contact me. So great. That's it.
Great. Appreciate it, Eric. Thank you.
No problem. Thank you.
So yeah, any questions, you can either get a hold of Eric or you can reach out to one of us founders who are happy to help as well and redirect questions as need be. But so with that, we will turn it over to our guests today. So we met this group at one of Richard Wilson's events in December in Fort Lauderdale. Thought their asset class was very interesting. I think you can figure out what their asset class is with their name, but this is the Motel to Apartments Conversions group. And Jacob, I'll turn it over to you to present your information. Appreciate you guys joining. Sorry. Also, if anybody has any questions, feel free to dump them in the chat or, unpause and raise your hand and we'll call on you as well. But Jacob, thank you for joining. Go ahead and take over.
Okay, great. I think Richard was actually going to kind of introduce himself first, since maybe a couple of you do know Richard already.
Sure. Yeah, I can just go real quick here, just to have some context. I run Family Office Club and we see 4,000 plus deals a year, and everybody would like me to help them grow their investment platforms because we run an investor club, but we have to politely say no to everybody because we're busy running the investor club. Motel to apartment conversions is the one group that we said yes to last year. One, I could tell right off they were genuine, nice people, and I don't want to work with anyone who's not. Second, I could tell they're very hardworking and they're open-minded. And when I learned they were both Eagle Scouts as I am, that helped a little bit. That's how I came up with part of the logo. Also, I did investigative background checks on both of them, which came out clean. I also documented our team's reference checks, 5 people each. I then de-risked my time further by introducing them to just 6 investors. 5 of the 6 wanted to give them money or a term sheet. And since then, they closed a $150 million net worth family on a $700,000 investment to buy a motel a couple of weeks ago. They also got a signed term sheet from a $1 billion balance sheet client of mine to fund all of their deals up to $350 million in assets under management, but we're still allowed to bring up 50% of each deal from private investors, from LFI, et cetera. So our normal minimum is $100,000. Through LFI, there's options to invest more, but typically we're working with people at the $100,000 level. But I just wanted to provide that context of how they got here, and really the thing that made me lean forward is basically that they are taking these really ugly assets that nobody wants, and they're turning them into workforce housing, which everybody wants. And so it's an arbitrage play. So I don't want to steal Jacob's thunder, so I'll stop talking now, but just want to provide that context of how they got here today in terms of connections between LFI and the Family Office Club. And I hope to see many of you at our next quarterly Investor Club Summit, because the last one was a lot of fun, and Chad was there along with Jim and many others from LFI. So thank you, everybody. Take it away, Jacob.
Awesome. Thank you, Richard. Yeah, and we're very fortunate to have Richard on our team. He's been a huge blessing, and he's a pretty great guy as well. He said that we're great guys, but I'd say he's a little bit better of a guy than Andrew and me. So we are motel to apartment conversions. Richard introduced himself and introduced us a little bit. My name is Jacob Amesco. I'm co-founder. Just to give you a little bit of background on me, then I'll turn it to Andrew. I graduated from Brigham Young University in Provo, Utah, with a degree in communications. I went to Westminster College to get my MBA degree. And then I went to 3M, big 3M, Fortune 100 company 3M. And while I was there, I was in product management and product marketing management. I ended up managing almost a $500 million portfolio of software products. Then I moved to Experian, and I was over their product marketing division. I went into real estate about a year and a half ago, actually, so relatively new market for me, but I'm doing a lot of the same things that I was doing for these bigger companies. My role in the partnership is analyst, underwriter, and operational, being able to put out processes and systems that are going to help us perform at our peak levels. And so that's me. And I met Andrew about, I think it's 12 years ago now. It's been a while. We served church missions together in Chile back in 2009. And so I really enjoyed getting to know him on the mission. And then we reconnected about a year and a half, 2 years ago. And I saw that he was buying motels and converting them into apartments. And like all of you who are here, I assume it was extremely interesting to me. And so for the past year and a half, we've been working together, and it's been amazing. So I'll let Andrew introduce himself. He has a little bit cooler story than I do.
No, very good. Great intro, Richard. Great explainer, background, Jacob. So I've done a sundry of deals, anything from single family to small apartment communities, smaller apartment complexes, anywhere from 8-plex to 16 to 20 units. And then from there, jumped into the motel game, kind of by accident, picked up a property that I found out that would lease for much, much higher than I previously expected. And I bought it for much, much, much cheaper than what a multifamily asset would actually sell for. So I'm buying a $1.7 million property, which should have sold for $6 million plus. And I carried a ton of equity into that deal. It was a 42-unit Motel 6. Exited, did it again on a couple other properties, did it again recently in Texas. We're doing it again in the Sunbelt states. And so far, that's how we united. So Jacob and Richard are definitely the brains. I'm kind of the operations piece of it all. And we are excited to work with LFI. So yeah, we acquire motels and hotels and we convert them into apartments. It sounds really simple. What's really great about this is I don't have to tell people in a million sentences what we do. They say, what do you do? I take motels and hotels and turn them into apartments. That's bar none. That's what we do.
Yeah, and there is a massive opportunity here. It's a very niche market, and not a lot of people are doing it. There are other groups that are, but we are focusing exclusively on taking these motels and turning them into apartments. So we're not doing any other type of single family, multifamily, industrial. This is our sole focus. And so you look at this opportunity that we have, there's roughly 142,000 motels and hotels in the United States. And that makes up about a $258 billion industry, the motel hotel market. Of those, the lowest hanging fruit for us, for our motel acquisitions, are independent motel and hotels. Doesn't necessarily always need to be that, but for the sake of this breakdown, that is the lowest hanging fruit because they're easy to convert to apartments. We don't have to go through the whole process of taking it from a branded Motel 6 to make it our own. And so out of the $103 billion of the independent hotel motel market, those that are suitable for apartment conversion, those that fit our buy box, it's about a quarter of that, about $25 billion market share. And so we'll walk you through what our requirements are, what our projects look like, and why we're targeting this market and what we've seen so far. But it's a great opportunity. We've seen a lot of success so far, and we're really excited to show you what we've done and what we have for an offering for you guys.
So the challenges of traditional multifamily, and if you've ever invested in any multifamily assets, you know exactly what these are. They're extremely competitive. You know, about 10 years ago, we started seeing an uptick in multifamily acquisitions. More investors, more money drives prices higher. It's also extremely slow, and the margins are not so fat. And the reason why it's slow is because it's a heavy lift. Typically, there's a lot of work that has to happen as far as 300 units, 200 units, back and forth in municipality. It takes forever, and the margins are not that great. If you're buying something with a cap rate or a cash on cash of 10%, to sell it, you're high pressure to get anything in a lower cap rate margin so that you can juice up the price. And it's really hard to do that in multifamily. It's a limited renter demographic. I mean, it's a 700 credit score or higher, and it's a low equity, high risk for investors. If you don't sell the property at a target cap rate, for example, everybody is saying, if we don't sell this at a 5% cap, then we're going to be in trouble. For us, it's very different. For us, it's very low competition. Very few are going after these deals. They're all over the place, and they're really hard to sell, which we'll talk about as well. These properties are hard for sellers to sell them. These are hospitality assets. These are properties that are motels, hotels that lenders don't like to fund, that insurance companies don't like to put out policies for. So we can buy these for super cheap, pennies on the dollar, because nobody wants them. What we see is different from what other people see. These are very high cash flow as well. For example, we're picking these up at $25,000 a unit, and we're renting them for $1,200 a month plus. So I don't know where you can find a $25,000 property that rents for $1,200 to $1,300. If you do, let me know. I'm interested. These properties do that all day long. It's very simple. It's very easy. We're very strategic about how we acquire and how we renovate these units, so it's still cost effective. There is a larger renter demographic as well. Traveling nurses, traveling corporate employees, workforce housing, locals, even senior citizens, even couples with one child. We have a very large rental pool. And instead of a lot of apartment complexes, A class, B class, saying no, we say yes. We do a background check. We do all the formalities of a apartment complex, but we're a little bit different because we can open up the space to a larger demographic. And it's high equity. We buy these things at a high equity. So if we buy, for example, a property at $25,000 a door, we put $20,000 into the door, we're at $45,000 in. And a multifamily for that same asset type probably sells for around $95,000 to $100,000 a door. So we're already at 50%. We have 50% equity in the property before we even start work on the property. So when it's said and done, we're sitting really pretty, and we have a lot of opportunity with a ton of equity.
Yeah, no, exactly. So in our markets, this is what we've done, and this is compared to similar multifamily acquisitions in the markets that we're in. We're in Texas and Arizona right now. We're looking to expand into other southeastern territories, Sunbelt states. But what we're looking at here is exactly what Andrew just laid out. The traditional multifamily acquisition between $95,000 and $100,000 for a finished product, renovated acquisition price right around $100,000. For us, our average acquisition price is around $25,000. Like Andrew said, we put about $20,000 into it, and so we're under $50,000 all in on the property. and the rents are comparable. It's a $1,200 to $1,500 rent for a normal traditional multifamily in the areas that we're looking in. For us, it's $1,100, $1,300, and we're half the price. We're almost getting the exact same rents, and so the cash on cash return per unit is almost double what it would be for a traditional multifamily acquisition. And so you look at the projects that we've done, we're only investing in assets that are going to deliver similar type results to multifamily, but half or lower cost of traditional multifamily. So we have 4 projects, and we'll go through a couple examples with numbers. We have Sholo, Arizona, which was a 22-unit motel that is now completed and 100% occupied that Andrew's going to talk about in a minute. Pinetop Studio Suites, 42 units in Arizona. Springerville, Arizona, 18 units. And across these projects, the actual and projected numbers, because we have a McAllen 29-unit project underway right now, it's anywhere between 21% to 65% investor IRR. The equity multiple is between 1.7 to 2.8, and levered cash on cash is 18% to 26%. And so these projects we're very proud of, and we're excited to keep expanding. We have 3 upcoming projects which we're offering to the group, which have similar returns. But Andrew's going to talk about the studio conversion process now.
So you guys are probably wondering, how are these guys getting $1,100 a month, $1,200 a month when they only paid $20K for the property? Obviously, there's additional costs in there and expenses. These are 100% furnished when we're done. I just want to make that very clear. These are furnished studios when it's complete. This property that you're seeing here is the Thunderbird Motel. We opened up the wet wall. We added a kitchenette, upper bottom cabinets, stovetop, fridge, sink, pretty simple. We added the right plumbing, the drains, the electrical. We got approval from the city. We did it all the right way. This unit right here, if you see the bottom right-hand image where it says finished cosmetic updates, that is only 190 square feet. That is not an ideal project for us. This was a project that we purchased because we couldn't pass it up. But our typical square footage, we're looking at 350 to 400 square feet studios. This is only 190 square feet. This unit right here brings in $1,200 a month. $1,200 a month for 190 square feet. So if you can think about the cost per foot that investors are putting into their properties, we're not expending a whole lot in this unit. These units, we only expended $8,000. I wanted to expend more, make it a little bit nicer, but I noticed we didn't need to over expend in this particular project. These are elevations and conceptual drawings of the current property in McAllen, Texas to spec that we have right here. It's 29 units. This is what the bathroom will look like, the kitchen will look like, the living area, and the exterior. These studios are going to be full kitchen studios. These are not kitchenettes. We don't say kitchenette. Kitchenette denotes, trashy old motel. We're moving that out of our minds. These are full studios. These have a full kitchen. It includes a dishwasher, includes a full oven, 220-volt oven. It includes a full microwave. It includes a full-size fridge, upper and bottom cabinets. It includes, we're adding beds, we're adding couches, we're adding furniture, we're adding media. We have a full-size TV. We have other furnishings and storage. There's even a stackable washer and dryer in every single unit. These are not motel rooms anymore. These are full-fledged studio apartments, and they're also furnished. Thunderbird Motel was a home run. A friend of mine said, hey, you don't need to showcase your investor IRR, you're bragging now. And I had audit reports done on this property multiple times, and it is what it is. If we were to sell today, which my investor doesn't want to sell, or investors don't want to sell, they want to hold this for the long run, but multiple offers on the table right now, if we wanted to sign them and sell, it's a 65% IRR. Investors making over double their cash. This property is always full. I have a line out the door of people that want to come in and stay 6 months to 12 months. They don't want to stay a month. They don't want to stay a week. They don't want to stay a day. They want to stay long-term. These are long-term studio rentals, lease agreements, the whole 9 yards. The average rent's around $1,100. That's actually kind of a low number. We just increased rents. They're actually hovering at around $1,250 a month. Occupancy is 100%. No, it's not a glitch. That's not a typo. I know a lot of times people don't like to see absolutes, but this is an absolute. We have a line out the door, people that want to be there. We've never had a vacancy. And yeah, this is just a great deal. This is 22 units in Shola, Arizona. This is the slated McAllen 29 unit. We are naming it Studios on 4th. It used to be La Casita Motel. And this, again, is going to just be a home run deal. This was one of the greatest deals we ever acquired. I'm going to take you on a journey real quick. We saw it for sale for $700,000. It's 29 units for $700,000. We went back to them, made them an offer at $680,000. We went back to them, made an offer for $650,000. We went under contract. Weeks before closing, we did inspections, noticed some more damage to the property than we intended, and we negotiated $607,000 purchase. And then we made an offer to only pay $60,000 down. They would carry the rest at 0% interest, $0 payments. So we did not pay. We're not paying anything any month. There's zero holding costs. We're not paying any debt any month for 18 months. It's an 18-month balloon. At the end of 18 months, we will refinance and or sell. Although our investors are so happy, they typically don't want to sell. They like to hold on to these for long-term. But our subscription agreements in our fund showcases a 3-year exit.
Yeah, exactly. So then, and that is a perfect segue into our exit strategy. And I think what we all want to get across to everybody is that we can be really flexible with our exit strategy just because we have such high cash flow on these properties and low payments. And so we can be very flexible if we refinance, if we can't refinance, if we sell, if we can't sell, we're going to be okay. We can hold these forever and cash flow them very well. Or we can refinance in 3 months, like Andrew mentioned for the previous property, Thunderbird. But we have flexibility in our exit strategy because we're in a position where it's very low risk, very low obligation for us to sell quickly. We avoid bridge loans, we avoid hard money lenders because we want to keep our investor capital safe. We want to have the flexibility and not have the pressure of we have to exit at a 5% cap in a year or 4.5% cap. That's completely the opposite of what we're doing. The exit strategy that we do have, even though it is flexible, is to rezone to multifamily. And what that does is it opens up an enormous pool of buyers for us. Like Andrew was mentioning earlier, the multifamily space is crowded, it's competitive, there's high demand for it. Everybody wants a stabilized apartment complex that is producing stable cash flow. Those are the assets that people are looking for. And our strategy is to rezone to multifamily and refinance year 2 or 3. It could be sooner. Thunderbird Motel, now Thunderbird Apartments, was 3 months after we were able to refinance and recoup about half of our investors' cash, and then sell year 3 to 5. And again, that's going to be variable, but we have the flexibility to do that. And this is the roadmap that we're looking at. And so we have 3 projects coming up that we want to introduce to you. And these properties are open. They're open to investors, and we are raising capital actively for it. Richard mentioned in the beginning that we have partnered with a large firm who has offered to provide 100% funding for all the projects that we do, up to $350 million. It needs to be approved by them. And we are able to raise the other 50% of these projects. So between the 3 projects that we're about to show, we have a $9 million target total. And so for us, we're looking to raise about $4.5–5 million to be safe. So Downtown 9, this is actually a property in Shola, Arizona, and it's walking distance from the last apartment that we just talked about, Thunderbird Apartments. So Andrew's very familiar with the area. So Andrew, I don't know if you want to give an overview of downtown.
Yeah,
9.
downtown 9's 50 units, slated to be 56 units when we're done. It's your mid-century, 2-story exterior corridor motel, your 1950s motel. And it's as cool as it sounds. Back in the day, these motels were much larger. Room size, these are around 350 square feet. And they're spacious. It's cement and steel landing built, so it's solid. Total renovation on this hovering around 2.5 million. And we have a property, the Thunderbird Motel is literally 2 blocks away from this particular one. This will bring in a yield of $1,350 plus a month for these units. They're much larger. So very excited about this deal. This one closes in the next 90 days.
Yeah, and then Brownsville, I don't know if you all are familiar with Texas and the South Texas area, but Brownsville is South Texas. It's very deep South Texas. And it's a growing area, and we're very excited about Brownsville. Elon Musk just put up his SpaceX in Brownsville about a year and a half ago. And it is booming. There are new industries coming in. The population is growing rapidly. We have additional materials on the Brownsville market that we can send out to everybody, but it is a great area and we are very excited to be in this area. This is another property that is going to close within the next 90 days. Similar returns to the Downtown 9 and our past projects. It's a $1.96 million purchase price, and the seller is actually financing half of that purchase price. And so we're looking to, and all of the deals right now that we have are actually seller finance deals. The equity that we'll raise for this project will be to cover the rest of the purchase price and then also rehab costs. And so this is where, and you'll notice that our pro formas here are an 8% exit cap rate. And the reason that we put it at 8%, it's high comparatively to what traditional multifamily properties are selling for. In Arizona, traditional property multifamily assets are selling between 4.5%, 5.5% cap, and that's what they're selling for. Brownsville, Harlingen, the one that we're going to show next, these Texas properties selling for a 6 to a 6.5%, 7% cap rate. Since these are going to remain studios, we're giving a little bit of a buffer and putting it at an 8% cap rate. And so these potentially are very conservative numbers because the cap rate could be lower than this, but we want to give ourselves some room, and we'll send over some pro formas as well, but we're giving ourselves a lot of padding in the amount of rent that we charge in the amount of our renovations. And so that's a breakdown of Brownsville, and it's South Texas, and this other one is in South Texas as well. It's a city called Harlingen, which is only about 20 minutes away from Brownsville. And so Andrew, I don't know if you have any insight into Harlingen.
Yeah, Harlingen is we got some great questions here. We're going to answer all these questions. Harlingen is a booming, it's a booming area. There's a Sam's Club, there's a Costco, there's a Top Golf. I know you guys are like, whoa, really? You know, so it's booming. We look for populations over 200,000 or more. We look for metropolitan areas. You might not even have heard of Harlingen, but it's part of the greater Brownsville, McAllen, Texas metropolis. It's a solid cement and steel build. It's 2-story garden style. It's got an interior, not an interior corridor, but it's got an interior courtyard with a pool, gazebo, and has areas for additional amenities to be added. This one is also a home run. This will be a real fun project. I'm going to go ahead and answer some of these questions, or I guess we can, I think we only have one more slide, correct?
Yeah, we just have a couple more, so we can wrap up here.
Oh,
so these 3 properties are going into a motel to apartment conversion fund. They'll be added into the portfolio. The fund is called Motel to Apartment Conversion Fund because those are the only types of projects that we do. So the partnership size, the fundraise is 50 million, and that's because we're going to keep funneling motel to apartment conversion projects into the fund. It'll be a 5-year fund, and like we've been saying, the target IRR is 20% and over. The target equity multiple for investors is 2x. And the terms that we're offering to investors, we're offering an 8% preferred return on the cash that is invested, active capital in the projects. After that, there's a 2% catch up, which means the next 2% of profits would go to the GPs. And then there is a 1.5% fund management fee that's involved. And then the profit share, anything above the preferred return and the GP catch up, 80% of all the profits would go to the LPs, the investor, 20% would go to the GPs, and we would continue that way until we hit a hurdle. So very incentivizing for us to deliver results over 15% IRR. So after a 15% IRR hurdle, then it would switch to a 70% LP split, 30% GP split. So these are pretty traditional fund terms. And if you've been pitched other properties, other investments, this might look similar to you. We're really excited because we talked with Jim and Chad and the left field guys, and we are going to offer special terms based on the tier, the level of investment that we receive from left field. So we're only offering this to left field investors. And you can see if it's anything under than 3 million, as a total investment from the group, we'll go with our normal terms, 8% preferred return, 80-20 split. After the hurdle, 70-30 split. And the last box, if you put in, this is just an example, if you put in a $100,000 investment across these 3 properties, this is the projected return that we're looking. You put in $100, you gain $126. So you get returned $226,000, if that makes sense. So $126,000 gain on a $100,000 investment. If we can raise between 3 to 5 million collectively as a group, we will increase the preferred return from 8% to 8.5%. And we will increase the profit split from 80% to 85-15%. And then the 15% IRR hurdle will remain the same. So you can see the 100K invested into projects under those terms would be about $132,000 profit. And then lastly, and we really hope that we can hit this, this would fund our projects, all 3. If we raised over 5 million, we would increase the preferred return from 8% to 9% for investors. The profit split would be 90% to investors, 10% to the GPs. And then after we hit the hurdle, it would move to the 70-30. And so you can see the $100,000 investment ROI would be $136,000. And so that concludes what our relationship or relation. I saw, did I see the word relationship somewhere? Maybe I didn't. But we're seeking 50 million. We're hoping to raise 5 million with left field investors. We went over the returns. The projects began early this year. Within the next 90 days, we're going to be closing on these projects. And so I'll keep these terms up. And Andrew, if you have those questions open, maybe we could start answering them now.
Yep.
Unless Jim, Chad, was there something that we wanted to conclude with, or should we just go right into the questions?
No, I think that's great. I think the only thing just to have you hit real quick is your offering is the fund 506B, 506C. Do you take non-accredited? We always ask that question too.
No, so this is for accredited investors. So it's a Reg D 506C fund.
Okay.
Yeah.
Perfect. That's what I wanted to clarify. But no, Andrew, if you don't mind walking through the questions, that'd be great.
Yep. Can everybody hear me okay?
Yep.
Cool. So we're going to start with Mr. B. Dwight. He asked, what percent, and thank you, Mr. B, for hosting these questions. What % of gross income is being spent on running the STR business? So here's another fun fact, not to overburden with everybody with more data, but I also own a company called buymoretime.com. And you can look that up, buymoretime.com. I don't want to distract anybody, but we use this company to manage our motels right now. We manage short-term rentals in 3 countries, 7 states, anything from Airbnb, VRBO, and motels. So that's what this other company that I built. I've been running that company for about 7 years now. That was actually a big proponent to what we're doing today. So what % of gross income? It's really based on the asset. It's based on the size. It's based on the software that we're going to use. But we charge everything back to the guest. The guest pays that. Obviously, if we're going to charge a guest, it does come out of our pocket in the end. But it could be anywhere from $20 to $30 per guest per month, sometimes less.
Yeah, and
Are you providing?
I was
go
just
ahead.
going to say, we can send over our pro formas, and our pro formas, it's about a 50%, 50 to 55% CapEx that we are anticipating for these projects. And so $100 comes in rent. We're conservatively saying $50 of that is going to be chopped off. So the net would be $50. Yeah. Sorry.
Oh, it's all good. Are you providing daily cleaning services? We do have an option if people do want to stay for a shorter period. We're pushing people into the longer period. We don't have people that typically request daily. We're full. All of our assets are full with long-term. When I say long-term, I'm talking 6-month to 1-year leases. Is it a possibility that we could open it up to daily and just charge out the wazoo? Absolutely. We definitely could. And if we do, we're going to be charging those daily cleaning as well back to the guest. And yeah, we do have a grounds team. The way we do it is we have, for every 20 to 30 units, we have one groundskeeper on site, maintaining the grounds, maintaining the units, so on and so forth. How are we different than Extend Stay America? Extend Stay America has limitations, like Marriott Courtyard or Fairfield Inn Suites. They have limitations on who can stay, how long they can stay. Extend Stay America doesn't have fully equipped kitchens either. They do have hot plates. I have seen Extend Stay America have hot plates. Some other minor accommodations. We have full closets. We have, dressers. We have, think of an actual condominium in a, bite-size asset. That's what we are. So we're a little bit different, but Extend Stay America is a good product. What's your cost of acquisition per guest? It's funny data, really just depends on where we are. We have teams that publish free, unpaid solicitations in Facebook groups and local online registers, and it didn't cost us a dime, and we fill up very quickly. So our asset is so magnetic. I'm not going to say we're the bee's knees, but a lot of times people see what we have to offer. It's ready to go. Hospitals love us. Workforce housing loves us. Traveling professionals love us. They just want a place for 6 months to a year. What is your cost? Okay, I already answered that. How do you determine if demographics fit? Okay, so we look for 200,000 population or more. We look for properties within 5 square miles of a hospital. We look for large retail centers. We look for Costco's. We look for Walmart's. We look for Sam's Club. Those denote, there's a lot of population here, a lot of shoppers, a lot of consumers. If there is no large big boxes like these, we probably won't invest there. We look for high traffic locations. We look for highways, freeways. And this is all inside of our buy box underwriting. It's a very lengthy list, but we're looking for median income of $80,000 to $150,000 household. So yeah, your B class and even A class areas, that's what we're looking for. C class properties in B class areas is the milk and honey, if we can find those. How do you determine demographics? We already answered that. George asked, are these typically located in business zones? Is it hard to rezone? That's actually part of our underwriting. We don't buy anything until we're 100% sure that we can and possibly will rezone. In the event that we cannot rezone, a lot of times they do issue conditional use permits, which is not a golden ticket to sell to a multifamily investor, but the cash flow is still worth it and justifies picking up the property anyways. Most of the time we do have the ability to rezone. Cities love us because they see these eyesore properties and they go, wow, these guys are going to come spend $1 million in our city, in our property. Yeah, we'll help them rezone. What kind of variances do you want? Do you want help? Do you want grants? Like, what can we do for you? Not a whole lot of pushback. They love guys like us. They're just glad someone else is willing to do it and not them. Can you please recap on your underwriting criteria for project selection? What's the tenant selection? So project selection, again, we're looking for properties that are over 20 to 30 units. Trying to avoid 20 to 30 unit properties. We want to be at the 60 unit plus. It just makes a whole lot more sense. 2 to 4 acres of land, 1950s or newer. I know that's really old and a lot of people get nervous, but in the 1950s, they built things really tough. We like block builds, block and steel. Love those types of properties. where we can just add new facades or facelifts to the front. On a lot of these as well, there's a lot of environmental stuff that we have to cover. For example, asbestos, radon. These items are definitely considered when we negotiate the deal. And the tenant selection criteria. We use a third-party company called AutoHost to vet these individuals. We do not allow anyone with previous evictions in the building. Of course, fair housing laws actually prevent me from saying stuff like that on a recorded line, so I got to be very careful with what I say. So we tend to give preference to those without evictions, and we tend to give preference to those who don't have grave crimes. But those who look really good, when you build a beautiful project, you only get the best coming to your project anyway. So we don't really worry about that. Other investors have been curious, hey, it's a motel that you converted. Are you still going to get lousy, sleazy people? We actually don't. We don't. We get young people who are professional, who make really good income. And the process by which we accept these tenants is very similar to an apartment process. It's all electronic, it's all automated. There's nobody at a desk, but they're still submitting pay stubs. They're still submitting their information, such as their credit score. You know, we do a background check on them. We find out who they are, and then we make a decision. So that's a really good question. Again, underwriting criteria for project selection, that's wide, but kind of covered that. The areas we look for: Dallas, Fort Worth, Houston, Corpus Christi, Phoenix, most of the Phoenix greater area, a lot of Texas, Austin. We'd love to pick up something in Austin, Florida, Fort Lauderdale, Florida, South Florida, really anywhere where there's high density in Florida, I think we'll be okay. What is the time frame on the rehab? Great question. It really just depends. A lot of times it depends on the property condition, but we're doing 20 to 30 units in 6 to 8 months because we want to do it right. Some people might say that's really long for 20 to 30 units. We want to do things really right. For anything larger than that, it could be a year to 18 months. Grand jumbo projects like 300 units plus could be a 3-year project, 2 to 3 year project. Hopefully not that long, but what we do is we immediately cash flow these. Okay, the initial cash flow happens on month 13. We immediately get these things fixed up, and if we have a wing that we can improve, we can fence off and beautify and market, and we can get people in immediately. We do that. We cash flow now. We don't wait till the end of the project to cash flow. We start cash flowing as fast as possible. What might be the stabilized cash return? Cash on cash returns historically for our projects are around 17% plus. So pretty darn good. Any other fund fees, acquisition and disposition fees? Jacob, you could probably answer that one.
Yeah, so the fund fee, and we're raising individually for these projects. So we're doing syndication, we're syndicating, that's how we've done our past projects. The fund fee is 1.5%. And then there are property fees. So there are 2 property fees. There is a project, I think it's a project development fee is what it's called. Anyway, it's 5% of the rehab cost. And so that's one of the fees involved in the property. And then there is a 1% asset management fee per property. And that is on the total invested amount. And so if you look at all the fees, if the properties were in the fund, it would be a 1.5% fund management fee, a 1% asset management fee, and then a one-time 5% project development fee. No disposition fee.
Typical breakdown of occupancy or break-even occupancy. Typical break-even occupancy.
And I think I saw one by Samip. Do the 84 units get reduced to lower number of apartment units? Okay, so do 84 units get reduced to lower number of apartment units due to combining of the rooms, or all they are studios, or are they all studios and number of units does not change for Harlingen as well? So for Brownsville and Harlingen, we are not planning on combining rooms. They are all going to remain studios. And we're confident in this strategy because, funny enough, these are almost completely occupied as is right now. And these are with week to week, month to month tenants. And so we're confident we're going to be able to fill the 84 units and the 73 Harlingen units as studios. The McAllen 29 unit, that's about 30 minutes away from Brownsville and Harlingen. That was also completely occupied, and they were running it as a motel, but people in that area, they were living there long-term, so week to week or month to month renters. And so for other projects, if it's a higher unit count, like we were looking at a 170 unit motel in Corpus Christi, and that might be a good candidate for combining some of the units to do a mix. But for the Brownsville and Harlingen assets, we're confident that 84 units and 73 units, just based on the history and the market demand, we're going to be able to fill those up. And so I hope that answers your question for that one.
Yeah, great questions. We can combine rooms later on with large assets, 150 plus, just like he was saying. Typical break-even occupancy, leverage percent, long-term loan terms. So loan terms, if it's a multifamily asset later, and we're typically going to see, we're trying to get better debt, and we're working on that. But it's your classic 65 to 75% LTV, 25% AM. On the loan terms on the back end when we refinance. Very, very typical commercial lending. Break-even occupancy. That's a great question. I don't know the answer to that.
Yeah, so it just depends on the property. I know for Sholo, the 56 unit motel in Arizona, that's going to be about 60% occupancy after the first year to break even, and that's going to be after that's going to be to start being profitable enough to pay out our preferred returns. And so there is a question here: how often does the fund pay investors back the 8%? So after 60% occupancy is when we begin to pay the 8% preferred return, and the goal that we have, the pro forma, is 13 months to start paying out preferred returns. And after 13 months, like Andrew said, it should be completed, most of the project at least, but we're going to be filling the apartments in the meantime and cash flowing as soon as possible, so that year one, we can start to have cash flow, and by year two, we'll be up and running.
Great question. How often does the fund pay investors back the 8%? Did you just answer that?
Yeah, so the 8% preferred return is during the hold period. And then the carried interest is typically during the refinance or the sell. And so we give the expectation that during the hold period, it's the investor can expect the 8% preferred return. And then on a refinance or a sale, which is it could be, maybe we've done 3 months before, we're planning on refinancing an account in 29 unit or selling it within a year and a half. But the carried interest, the profit split on the back end will be on the back end on the refinance or sell, and the preferred return will be during the hold period.
Individual syndication. Yeah, we have different fees. We can work with you one-on-one on that.
Yeah, so individual syndication, and what we've been offering to investors is the same. It's the same 5% project development fee, and then instead of a 1.5% asset management fee, instead of a 1.5% fund fee and a 1% asset management fee, we've been offering 2.22% asset management fee instead on an individual property. And so we feel the fund is advantageous to investors who want to mitigate their risk a bit and spread out their investment across multiple of these projects. But we do have investors also that want to invest on a deal by deal basis if they like Arizona or if they like Texas. But all the projects that we've shown today of the three, we're confident in all of them, and they will have similar returns, projected similar returns. But hope that answers your question, and we can go into a little more detail on that. Send a follow-up.
Kumar, great question. Actually, we have an investor named Kumar, good guy. Is there a property management fee? Yes, we will be charging a property management fee. Jacob might have that handy. And yes, it is vertically integrated. So we will be working with buymoretime.com and our virtual teams to manage the property virtually. We use a lot of different software. There's a lot of not a lot, but there are some overhead costs that we need to take care of with that fee, including software and man hours.
Yeah,
But yeah.
Property management. I mean, we're really excited about it. We think that we have already begun the process of really changing the game for how property management works. We're improving, but right now even it's very exciting. We have a virtual team managing the customer service, the leasing process, the marketing, and basically anything that can be done online is being handled through the virtual team that Andrew has founded, Buy More Time. And then we do have a grounds team, and we will have an on-site property manager, property grounds person. And then we also have security built into the pro forma, so that there can always be somebody patrolling at night as well. And so
what we're building is pretty groundbreaking. We're building a multifamily asset with flexibility that anybody can walk up to, fill out the kiosk, get the code to their studio, sign a 6-month, 1-year lease, pay the deposits, move in. And this could all happen within 15 to 20 minutes. So this will be all interconnected software-wise, all managed, really hands-off. And then if there's any questions, there's back and forth with the virtual team that's open 24/7. And the virtual team's open 24/7. They actively manage our projects now. Guests can message our virtual team at 1 a.m. in the morning, we answer it. So that's the vision. And we actually have a few names of potential rebranding later on if we want to group all these into one large portfolio called Stay. But it's exciting. Until the properties are stabilized, are you funding purchase and rehab costs using investor money, or having seller carry the note? It's both. So the sellers will carry the note, and or we will just simply use the equity from the investors. So either one. We like seller carry transactions because we put together some really advantageous seller carry deals. Meaning there's no loans available from bank. Yeah. Meaning there is senior debt other than the note from the seller in the capital stack. Yeah, so basically it's just the seller. The seller is the first lien holder, right? That's the first offer. Actually, our very first offer is cash, and it's a very low offer. When we approach a seller, we offer something abysmal. If they want $5 million for the property, we're offering $1. We find out what they want for the property, what they're willing to do. A lot of times we'll come to close to their price, but we have them carry. And we'll pay a very low % down, and they'll carry the rest on interest-only payments. What % of the equity multiple is covered by depreciation?
Depreciation is not factored into the pro forma. It's not factored into the equity multiple. So the numbers that we're seeing, they don't include any type of depreciation. So I know that some firms will include that in the equity multiple, maybe to pad the numbers, but this is not yet. There's no depreciation factored into the pro formas.
Samip, we buy a lot of properties. What did you ask? You asked property stabilized funding purchase rehab costs. Yeah, we buy a lot of properties seller financed. And I think it's because they can't sell these so easily. It's hard to sell a motel or a hotel. What would the investor expect to get in the K1 accelerated depreciation year 1 due to cost segregation? That's definitely a tax.
Yeah, question. We're gonna have to ask our account. Yeah, we'll ask our accountant and get a good answer.
Great question. Yeah. I'm not afraid to say I don't know the answer. So
Charlie does.
We have an educated and engaged group here at Left Field. Really appreciate you guys managing the questions that are coming in. We do have a couple minutes if there are any others. There was one I saw that got skipped talking about utilities. Are utilities included in the rent that you bill back to the tenants themselves?
We charge back to the tenants those utility costs. In prior projects, we haven't because we have solar on our properties. On one, we have solar that are in our people can run the electricity as long as they want, but we're only going to pay like $300 to $500 a month.
Yeah, the marketing though for the product for tenants is that this is the cost. They're not necessarily they don't. It's not like they have to take out the utilities in their name. We're not getting, yeah, we're not having them transfer any type of utilities in their name. We say this is the cost. It includes your utilities, it includes your internet, but charge back. We are charging back utilities to the customers.
Yeah, so what we do is analyze their, Mr. B. Dwight has some great questions. These are excellent questions. So we do not individual meter these, no. And yeah, we do have a program where we would charge back utilities based on certain factors. There's some marketing angles that we could flex where we can include the internet for free, quote unquote free, right? But we probably secure a fiber internet package on a 5-year contract for extremely cheap because we paid it up front or something like that, or a portion up front. So really, we actually arbitrage the income by bumping the rental income up higher, and we put it under a guise of free internet. It's not really free. You're paying it through the lease agreement. For other utilities like water, sewer, water, trash, electric, yeah, a lot of these we have to analyze in our underwriting stage, the cost and the kilowatt hours that we're charged for. We even have a third-party company that audits these bills and sees how honest they were. And if they are, then we'll just charge it back to the tenant without having to make it all inclusive. If it's going to be a burden on us, we don't want them to run the bill and then we have to cover the cost. Are solar panels part of the asset hotel conversion project? They can be. It really depends on if it's going to be economic. There are a lot of factors, tax benefits or question marks, I should say, depending on where it's located, what state it's located in, and then just the cost of installing it. We don't want any programs. There's a program out there called a PMA where you basically get free solar, but you got to pay a new solar company or a new energy company. We want to stay away from that. We want to have full equitable rights to our solar. Do you maintain the reception office or convert it? Yeah, we convert it. Great question, George. We convert it into another unit. The reception office is just another unit. We do have a groundskeeper. There is one groundskeeper on the ground. So there is someone there.
Yeah,
which
and
is part of the expense.
Rule of thumb is about for every 30 units, Kumar. Yeah, he asked that.
Right.
As well.
Every 30 units, we have one individual. So, and usually our hiring team finds a couple. We go through a lot of different applications and we find the right couple that is handy, a couple that obviously checks out, their background checks out, everything checks out with references. We set up an agreement and a contract on a 6-month performance period. After 6 months, if they exceed with flying colors, we'll try to keep them as long as they'll stay there. But yeah, great questions.
Yeah.
On-site person for every 30 units.
We're up against our hour, so I want to be cognizant of your guys' time too. But there was one other question in there that Kumar brought up. Maybe you could speak to real quick about have you taken any of these properties full cycle yet?
Yeah, so the Thunderbird Apartments, that was refinanced 3 months after, and the capital was returned back. It was about 40% of the capital was returned back to the investor, and that is still in the hold process. Pine Top Studio Suites, that was actually a private syndication between us and one other individual, and that individual actually bought out the GP. So that was an exit where the investor actually bought and is now holding the asset himself. And so those two would be, I guess you would call Pine Top Studio Suites full cycle, although the investor is still holding it, and then the refinance on Thunderbird, which is still actively held.
Gotcha.
Great
Appreciate
question.
it. Well, yeah, a lot of great questions. Really appreciate you guys taking the time to go through everything. If people have other questions, please reach out to these guys. They'll be happy to help and vet the deal, continue to vet the deal as need be.
Kumar, I wanted to sell it. We wanted to sell it at the going cap, which was like a 5% cap rate. I gave him a deal and sold it at around an 8% cap. So it was an exit that allowed him some equity. Yeah, it's a friend. So if that answers your question, Kumar. Yeah. Does city put any low income units in the rental program? We're not subsidized. We don't do subsidies, guys. These are not Section 8 housing. Again, fair housing violations all over this call. We're not, we don't accept vouchers. I can't say that, dang. We look for highly qualified tenants. How about that? Anyways, I hope that answers your question without getting myself in trouble.
Right. The last thing I'll bring up too, I want to reiterate the tribe. This is something new that we're kind of doing this year, is offering a tribe to group invest and get in at lower minimums, because we'll group them from the investments together. I do want to ask, I don't mean to put you guys on the spot, if people want to invest at the 100 grand minimum or more and want to directly invest with you, will you group that together with anything that we put together in the tribe to give LFI credit, if you will, accumulated credit towards your thresholds you have on the screen right now?
Yeah, that's fine.
Okay, perfect. They just need to call out, if they go directly invest with you, we'll just have them call out that they're left field members and so forth. And that way we can compare notes and make sure we account for everybody. But we'll lump together. People can invest 100 grand in the tribe as well if they want to go through the tribe and we get fewer checks to these guys, lump it together. But you're more than welcome to do either or for this case as well. But really appreciate the time today, guys. A really interesting asset class. Like what you're doing a lot. We were intrigued by it when we met in Fort Lauderdale, and I think you probably will spark something in the community as well. So really appreciate you coming on and sharing your information with us.
Yeah, I really appreciate you opening up this audience and opportunity to us. It was a pleasure to meet everyone and answer your questions. I could tell you guys are very, yeah, like you said, Chad, sophisticated, savvy investors. So
yeah, contact information, we'll make sure we send it out in the email as well. So all that will go. So if people have more questions, they can reach out, or you can go look them up under Motels to Apartments. So really appreciate it, guys. Thank you for everything you provided today.
Thanks,
you guys. Appreciate it.
All right. Thanks everybody for attending as well.
Talk to you later.
Okay.
Yep. Bye-bye.